Let's talk about the psychology of when to take profit. Here's my suggested path for most people, and maybe something I will do this time myself, is we don't know what the cycle peak is going to look like. We don't quite know when it's going to be. We do know it would be crazy early if it finished this year. Usually the back part of the year after the US election, there's usually a screaming pump into the end of the year. So my advice is use that in terms of time and not price, and take maybe a third off the table for lifestyle chips.
As we progress further into the crypto bull market, many investors are wondering when it would be appropriate to begin taking profits to avoid getting caught in another harsh crypto winter that will undoubtedly be characterized by severe 80 to 90% drawdowns. The consensus is that we are currently transitioning from crypto spring to crypto summer, which means there is still enough time for crypto asset prices to climb higher before the cycle peaks sometime in 2025. Most experts estimate the cycle will last another 12 to 18 months, so all profit taking must be made within that window. For Real Vision founder and CEO Raoul, profit taking is a multifaceted issue that must be appropriately timed to avoid missing what he describes as the best investment opportunity ever given to humanity. Pal believes the best approach to investing in the cryptocurrency industry is having a long-term time horizon and riding the wave during both upside rallies and drawdowns. While discussing the issue in a video recently uploaded on his Raoul the Journeyman YouTube channel, the former Goldman Sachs executive gives the example of his first Bitcoin investment, stating he could have made so much more money if he hadn't sold when he did. While he acknowledges there could be some merit to appropriately timing the market, Pal says it's more prudent to fully ride the wave until at least 2030, when he believes the coming technological revolution will make the world completely unrecognizable. As we bring you clips from Pal's video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Let's talk about the psychology of when to take profits, the cycles that we know are there, and let's just think it through together, because it's going to vary for everybody, and that's a key thing. So as we know, crypto is very cyclical based on this everything code thesis that I've built, which is there's a debt refi cycle that happens every 4 years because everybody reset their interest rates in 2008 to zero and then made all the government debts in around 4 years, 3 to 5 years. And it's created this endless cycle, which happens to be the same as the Bitcoin halving cycle and the US presidential cycle. So we're faced with these cycles. And out of 3 years, crypto is the best performing asset in the world. In year 1, crypto spring, year 2, crypto summer, year 3, crypto fall, and macro spring, summer, fall. And then year 4 is the worst. And the worst is what scars people. And people want to know how to deal with this. How I think about it first is you've got to establish what are your goals here? What is your time horizon for your investments? So if you're saying, my big macro thesis is this space goes from, let's say, $2.5 trillion today to, let's say, 10 to 15 trillion at the end of this cycle, depending how big this cycle is, to 100 trillion by, let's say, 2032. So we've got the largest wealth generating macro trend of all time, and it's still in front of us. Yes, the early days were super high returns, but it's still super high returns. So we don't want to this up, right? We want to capture that. So a lot of people start thinking, well, should I trade out in macro crypto fall, try and sell that peak and then buy in the bottom, and then I don't have to go through the horror of the 75% drawdowns? So for those of you who don't need the money now, then I would take that cycle, the down cycle, with utter joy and add. Expect to see an 80% drawdown. Maybe it's less this time. Maybe it's more. Solana was down 97% this time. ETH was last time down 97%. And embrace it, because every time you buy those lows, you're going to 10, 20, 50x, depending what you're buying. Just of major coins, right? So it is a huge wealth generator. If you imagine Solana last year was a 10x in crypto spring. We haven't got to summer or fall yet. We're just transitioning to summer now. So if you've got a long-term time horizon, you will definitely make more money by following that route. Buy the sell-off, embrace it, have cash ready for it. Right now, we're probably in the last opportunity to put cash into the market. So if you've got cash or you're waiting, now is the last chance, because after this, we hit the banana zone and everything goes a bit crazy. And then it becomes unviable, and your entry levels, if we do have a bear market, then you're below water. You should not be from these levels. So, or not by much anyway. These are good final levels to jam in as much as you can. Okay. So if you're the long-term person, wait for 2026 and go, yeah, I can't believe I can get more and compound more wealth. Get some cash ready for that and be ready when everybody's panicking. You be the person to stand up and say, I got money. The other route, a bunch of you say, well, I want to take everything off the table. I don't want to deal with the stress of the down markets. That's fine too, right? We all need to understand our own psychology and our behavior patterns. I can't help you with timing the top. I know that it should be, by my work, sometime in summer to winter of 2025.
Anonymous Bitcoin analyst Plan B has a slightly different perspective on timing the market. Plan B's preferred time horizon is buying 6 months before the halving and selling 18 months after the halving. In a post shared on social media platform X in March, Plan B wrote, "All Bitcoin price increases have been around halvings. If you bought Bitcoin 6 months before each halving and sold 18 months after each halving, then you would have 4 Bitcoin instead of 1 Bitcoin. Is this spurious coincidence or a pattern/signal? And will it continue?" In response, another Twitter user comments that timing the market is risky because there is no way to know when prices will truly take off. Here is Plan B's reply to the observation. Trying to avoid the worst of -80% bear markets after face-melting bull markets is more like risk and liquidity management than timing the market to me. Let's get back to Raoul Pal's video.
Here's my suggested path for most people, and maybe something I will do this time myself, is we don't know what the cycle peak is going to look like. We don't quite know when it's going to be. We do know it would be crazy early if it finished this year. Usually the back part of the year after the US election, there's usually a screaming pump into the end of the year. So my advice is use that in terms of time and not price, and take maybe a third off the table for lifestyle chips. Okay, now you can buy your car or your house if you're lucky, or whatever it is, or some extra savings, right? Take some money out of crypto land, put it into fiat world where you live, secure your lifestyle, the things that matter to you. Right, now you've taken all of the pressure off. You've done it via time and not price, which is towards the end of the year, I'm going to take a third off. I don't really care what the price is because it will be up a lot. So I'm just going to take it off. And then now I've de-risked my life so I can now run 2025 more intelligently. So 2025, you can then run with the rest of the money that you've got, the 2/3 remaining. And you can say, okay, I'm going to take some off by about the summer if I wanted to take more off. Maybe you don't. Maybe just run the rest because you've now de-risked your lifestyle. That's my favorite approach. But what I would have a tendency to do is if we do get a mega pump, the 2013-17, then take another third off when that happens. If it doesn't and it gets stunted, it doesn't matter. You've taken a third off, you've protected your lifestyle, and then you can then buy some cash with that. If you keep that cash, you can buy the dip, or you use it to, as I said, for your lifestyle chips. But this way, you're now ready for whether it stops early. You don't care because you've taken your money off the table, but you're still in the game, right? That being in the game is the secular trend. That's the most important thing to me. But if it really goes wild, you take a bit more off and you can put it into the lifestyle chips bank. And then you've still got a position. Because if you don't have a position in a secular market, I think you end up making suboptimal choices. So that's how, now you might not say a third, maybe it's 50% for you. It doesn't matter. What I'm trying to give you is an idea of not trying to nail the top, trying to think in terms of time zones and then how much lifestyle chips de-risks your life. Because I think it's too important a trend to this up. So that's the best advice I can give. I will probably do the third off strategy this time around because I've got some lifestyle stuff I want to do. I did not last time. and I was bloody happy with not doing anything but buying the dip. I will absolutely buy the dip in 2026 because this trend is going to keep going. Remember, 2.5 trillion to 10 to 15 trillion. 15 is the pump. The 10 trillion should be normal to 100 trillion. That's the game we're playing here. Let the cyclicality be your friend. Understand that there are seasons that you can use to your advantage. We are transitioning right now, and I'm talking to you, this is Sunday, the 12th of May, I'm recording this. We are just transitioning where we're about to hit crypto summer. And that usually happens June, July of the season cycle. And then it goes bananas. Of course, there will be corrections, and there will be sharp corrections. 30, 40% can happen. But it usually goes up into the banana zone from here. That's when you've got to be careful not to lose your mind and up doing other things you shouldn't be doing, like putting all your portfolio into meme coins because they're going up the most, because you want to maximize profit. Think of this as a longer term game. You'll make plenty of money if you stay with a secular trend in the big tokens and have a small amount to play in the other stuff.
PAL's exponential age thesis is based on rapid technological advancements, especially in the fields of robotics and artificial intelligence. According to PAL, the world's severe debt problem is worsened by the aging population and reduced productivity. We are simply not producing enough to assimilate the massive debt load naturally. This is where PAL believes AI and robotics come in, changing the entire GDP formula by bringing in infinite productive units and exponentially increasing productivity. In his words, AI infinitely scales knowledge, and robotics infinitely scales physical work. As a result, PAL believes the productivity boost we will get from the exponential age will solve the debt crisis and significantly increase GDP growth, eliminating the need for a global collapse. After 2030, PAL believes the world will be completely unidentifiable, as the exponential age will change everything we know about economics, finance, and investing. This is why he urges investors to make the most of the immense opportunity the cryptocurrency market presents now before everything changes completely in 2030. What are your thoughts on Raoul Pal's video and Plan B's tweets? Do you think it's better to take profits after the peak in every cycle and return during the bear markets? Or do you prefer Pal's longer time horizon thesis? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.